Let's jump right into this, shall we? Welcome to The Explainer. Today we're unpacking a really fascinating business paradox. It's a situation where a massive gaming platform actually did the right thing for its users, specifically its youngest, most vulnerable ones, and ironically suffered an absolutely devastating financial hit because of it. We're talking about Roblox. It scales like a giant social network, and we're looking at the incredible financial whiplash they experienced just from trying to make their digital world a little bit safer.
$9 billion. Wrap your head around that. At the end of July 2026, Roblox wiped out a staggering $9 billion in value in a single trading day. This historic nosedive happened right after the company reported missing their financial projections by hundreds of millions of dollars. For a company that the market has historically just loved, this was a total shockwave. I mean, it sent investors into an outright panic. So, that brings us to the central mystery of today's explainer. How in the world did pushing kids toward higher quality, safer games directly trigger one of the biggest single-day stock crashes in this company's entire history? Why on earth did making the platform objectively better for its players cost Roblox $9 billion overnight? Let's figure it out.
Section 1. The $9 billion drop. A market shockwave.
To really grasp the sheer panic on Wall Street, you've got to look at the scale of this cliff dive. Back during the summer mania of 2025, driven by those massively viral hits you probably remember, like Grow a Garden and Steal a Brainrot, Roblox's stock price shot up to over $130 a share. But fast forward to late July 2026, and that same stock plummeted to under $40. That is a brutal 70% drop year over year. The market, which usually loves the fact that players make the games themselves for free, was totally spooked. And making that share price drop even worse was another startling number. They lost 30 million active users compared to the previous year, all while missing those earnings projections by a couple $100 million. Because of this nasty combo of user drop-off and missed revenue, investors stopped treating Roblox like the guaranteed moonshot it used to be. The assumption that the numbers would literally just go up and to the right forever? Yeah, that was completely shattered.
Moving into Section 2. Changing the algorithm. Shifting discovery.
So what actually triggered this massive reversal? Well, to understand the crash, we got to look under the hood at a key metric called bookings per hour played. Basically, this is the absolute lifeblood of the Roblox economy, and it's the #1 indicator Wall Street watches to judge if the company is doing well. It tracks the exact rate at which players are handing over real money while they're actively playing, and obviously, when that number drops, the alarm bells start ringing.
Here's what happened. Roblox fundamentally changed its discovery algorithm, specifically targeting players in the US who are under 13. They purposefully shifted the platform's focus away from games with super aggressive, short-term monetization. You know, the games designed to get players spending cash as fast as humanly possible. Instead, they aimed the algorithm at what they call measured long-term retention. They basically wanted to highlight games with stickier, higher quality engagement. Places where kids could actually hang out and have fun longer without constantly being nudged to open their virtual wallets.
Let's hear what leadership had to say about it. CEO David Baszucki explained to investors that this was a highly strategic move. He noted that their data showed a real positive lift in quality and stickier engagement. He outright stated that prioritizing this long-term ecosystem health, quote, outweighs the near-term impacts we're seeing, as improved retention and engagement compound into future growth. So they totally knew they were going to take a financial hit right now, but they believed it was absolutely worth it for a healthier, more sustainable platform down the road.
All right, Section 3, the cost of quality. Short-term pain.
And as we're seeing on the financial side, prioritizing that long-term quality comes with an immediate, seriously heavy price tag. Because kids were being actively steered towards games where they could play longer for free, that crucial bookings per hour played metric we just talked about naturally started to dip. Because of this, Roblox had to project a brutal 14 to 18% drop in third-quarter bookings year over year. For investors demanding constant growth, projecting a near 20% decline is a massive flashing red flag.
There were a few specific factors acting as headwinds here, holding back the company's short-term profits. First, the algorithm literally gave fewer impressions to aggressively monetized games. Plus, Roblox rolled out new safety measures to curb predatory user behavior, deliberately shifting the spotlight away from casino-style experiences. Now, to you and me, that sounds great, right? But from a hyper-focused investor standpoint, these safety guardrails simply added friction to the user experience, making it much harder to monetize the players quickly.
Which brings us to Section 4, Wall Street versus the players, an ideological divide.
This whole situation really highlights a massive, glaring divide between what corporate boardrooms care about and what the actual users care about. Take the Wall Street view, summarized here by Roblox CFO Naveen Chopra. He called the shift away from those highly monetized 2025 viral hits and, quote, unforeseen monetization shortfall. It was purely a negative financial surprise to them. The boardroom sees players moving to games that make less money per hour, and they view that strictly as a failure of revenue generation. It doesn't matter to them if the games are safer, higher quality, or just more fun to play.
But conversely, the player base and the general public viewed this entirely differently. A Kotaku commenter going by the name Grimfalcon really hit the nail on the head. They pointed out that the market was essentially punishing Roblox for tricking fewer kids. People are looking at the financial sector losing its mind because a children's game implemented safety tools that stop young users from essentially gambling with their parents' credit cards.
Yeah, and as another reader bluntly put it, the friction between implementing basic, ethical safety guardrails and pleasing investors has created a wildly cynical reaction from the gaming community. Many players are looking at a system that demands infinite financial growth, and they're understandably frustrated. They're watching a company lose billions of dollars in value precisely because it tried to create a safer, less predatory space for underage users. It's wild! And so, we're left staring at the ultimate challenge for Roblox. A true business paradox. Moving forward, how do they crack this code? How do they figure out a way to still make enough money to keep Wall Street happy while simultaneously funneling kids into higher quality games instead of those highly monetized casino-style experiences? Can they actually balance a healthy, safe digital environment for young minds with a stock market that literally expects financial charts to only ever go up? Which leaves us with a final provocative thought to take away from this explainer today. When building massive platforms, especially ones where the primary audience is literal children, can the uncompromising demand for infinite shareholder growth ever truly coexist with ethical design and user safety? Is it actually possible to satisfy Wall Street without compromising the well-being of the players? Honestly, it's a heavy, complex question, and one that the entire tech and gaming industry is going to have to reckon with very, very soon. Thank you so much for joining me for this breakdown, and I will catch you on the next explainer.